Hi everyone, welcome to another class in our Option School series. Today I will talk about how to manage covered calls so that you don't lose your shares. I'll start with an example of a covered call management and then talk about the differences between traders and investors and show you some trade management rules and finish everything with a few more examples. In the previous class, I kind of finished the class with showing you this trade, right? I sold open Microsoft on the 3rd of March and the strike price was 275. And I was hoping that the call would just expire worthless. I mean, at the time I entered the trade, Microsoft was trading around 255. The expiration date was 3 weeks away. So I did not expect Microsoft to go up more than 8%. And unfortunately, it did. In fact, it went up 9% and a little bit, right? So I was forced to buy the call back because I did not want to lose the shares. And I told you also this was only part of the story. So what's the full story? Well, the full story is this. So on the 24th of March, I did buy the call back and for a loss, actually for quite a big loss. But at the same time, I sold another call, another covered call with a higher strike price and expiring 1 week later. And for that trade, I was able to get some credit, about $350, right? And then the call was expiring 1 week later, unfortunately. So the strike price was 280, but 1 week later, Microsoft was trading at 286. So again, the call was in the money. So I rolled again. So from 280, I rolled to 287 and a half and extended it by 3 more weeks from the end of March to the 21st of April. And at this time, I was not able to get a credit for the trade, but I had to pay a little bit, to get the roll. Thankfully, on the 21st of April, remember my call was at 287 and a half, and Microsoft on that day closed below 286, so the call was out of the money and expired worthless. So throughout, the whole campaign, I made one entry, right? I sold one covered call, and then I made one roll, another roll, and then the call expired worthless. So altogether, like 1, 2, 3 trades plus the worthless expiration, so not too bad. And I made a little over $800, right? Percentage wise, not a huge gain, but I was very happy that A, I made money, and B, I got to keep my shares. So that was the important thing. So you can see the profit just from the covered calls was less than 0.5%, but the stock during that time went up over 12%. Stock went up over 12%, and overall the profit was almost 12.5% for the trade. You can take a look here on the chart, right? Here I sold the covered call here. That was the entry trade. And you can see this is the strike price for the call expiring somewhere here. And you can see that it's quite far from where Microsoft was trading. So the trade felt very safe. Unfortunately, Microsoft started going up, and on Friday, the expiration Friday, the price was above the strike price. So I entered another trade with a new uh, strike price, right, expiring 1 week later. And again, Microsoft went up this time quite a bit. And so I had to roll the call again, and I rolled it to 3 weeks out and with a new strike price, and Microsoft ended below that strike price. So I got to keep the shares, and I also made some profit overall on all those trades. So let me explain to you a little bit how these things work and why this strategy actually makes sense. So let me concentrate on just this part of the code, this one particular row, right? You can see I actually had to pay a little bit of money to do the roll. And that was because Microsoft, At that time, I was trading at 286, but my option was at 280. So it was quite a bit. It was like 2% in the money, more than 2% in the money. And then that makes it a little more difficult to roll the options, right? So I was facing two choices. Either I do nothing and let the shares just be assigned to me, and let the call be assigned to me and let the shares be called away, right? So if the shares were called away, I would get $280, the strike price for each share. I had 800 shares, so I would get $224,000 in my account, and the trade would be over. So instead of getting the 224,000 in my account and losing all my shares, I decided to extend the trade. I extended it. I raised the strike price from 280 to 87 to 287 and a half, and I paid $210 for it. And I still have my 800 shares. That's the important thing, right? And expiration of the trade was 3 weeks later. So I extended the trade by 3 weeks. I raised the strike price and I paid a little bit of money to make this happen. And essentially, the worst thing that could happen to me at this point would be an assignment again, right? Assume that Microsoft went up really crazy. On the 21st of April, if I were assigned a call, meaning the shares would get called away, they would get called away at the new strike price, right? New strike price to 287 and a half times 800 shares would be $230,000 in my account, much more than the 224 that I would have gotten, 3 weeks early. So the difference, if I add also the money that I needed to pay for the roll, the difference would be 5,000, almost $5,800. Percentage wise, considering how much money is tied in Microsoft, it would be about 2.6% gain. So instead of being assigned on the 31st, I decided, okay, in the worst case, I'll be assigned on the 21st of April, 3 weeks later, right? And doing that, I will make 2.6% on my overall investment, in just 3 weeks. That's an amazing return, right? So I'm really not doing anything bad here by rolling from 280 to 87 and a half. In fact, I'm extending the trade and increasing the potential, the profit potential significantly, right? If I can make consistently 2.6% every 3 weeks, I would be very rich. You can see there is a really, like, the strategy that I'm kind of proposing here is good for investors, is good for people who really want to keep the shares. Traders in general, they would not do this. They would, on the first trade, they started with Microsoft at 255. Microsoft then in 3 weeks reached, over 275. They don't care how much over, and they're happy to, be assigned the calls and have the shares called away at 275. And plus they get the premium from the covered call and they can move on to the next trade. However, investors, they want to keep their shares typically, right? So traders in general, they have short-term horizon, many of them minutes, hours, some days, weeks. On the other hand, investors, they have long-term horizon, weeks, months, years, often decades, right? Traders, they usually trade in and out. They enter a trade, exit a trade, move to next opportunity. Whereas investors, they typically use the buy and hold strategy. They buy a stock or ETF and hold it for an extended period of time, often forever, really. And so, again, traders try to profit from short-term price fluctuations, and traders, on the other hand, try to profit from long-term value and long-term trends, right? The investors focus more on the fundamentals and less on technicals, whereas traders they focus more on technicals, right? So investors, fundamentals, traders, technicals. That's kind of typical. Of course, there are investors. I mean, I, as an investor, also look at the technicals, but in general, the fundamentals are more important when I make my choices. So, to continue this, traders essentially for covered calls, they buy the stock and sell the covered call, typically as part of one trade, and their goal is maximizing short-term profit. So they are actually very happy when the option is assigned and the stock is called away, right? And they use the covered calls to kind of reduce their risk and amplify profits, right? Even if the stock doesn't move much, they can still profit from uh, the premium that they got from selling covered calls. On the other hand, for the investors, their main goal is to buy and hold a stock for a long time. And they only sell call opportunistically. And the main goal of investors is asset accumulation, capital appreciation. And because of that, they are very unhappy when the stock is called away because they don't have the stock anymore. They are potentially missing some significant profits, right? So investors, they use the covered calls either for steady income or cost basis reduction, things like that. But again, their main goal is to buy and hold a stock. So with that in mind, when it comes to covered calls, traders essentially are more aggressive. They write at the money or nearly at the money calls. Their trades are more frequent. And again, their primary objective is short-term profits, right? And so for traders, there's really no need to manage the covered calls. They're happy when when the option is assigned and the shares are called away because they reach the maximum profit potential, right? On the other hand, investors, they want to keep their shares. So they need to be a little more conservative. They write further out of the money calls. And typically, investors trade covered calls less frequently, right? And again, let me remind you, the primary objective of an investor is preserving the underlying stock. And only the secondary objective is the income that they can use to reduce cost basis, anything. Uh, so for investors, because they want to keep the stock, they really benefit from the covered call management. So how do you manage the covered calls? So first of all, to start with, you should sell calls that are further out of the money, right? And second, avoid things like earnings announcements. During earnings announcements, the stock can move significantly very quickly. And if that happens, it's actually quite difficult to roll the call to later expiration and higher strike price. Also, one thing, keep in mind, watch for ex-dividend dates. So one day before ex-dividend, one day before the ex-dividend day, there is a danger, that your option might get assigned to you. So I'll talk about that a little later. So what's the best strategy kind of to roll the call options? So when your call option is out of the money, well, you can just let it expire, worthless, right? When it's at the money or in the money, then a good strategy is to roll to an at the money option or slightly out of the money option, because that kind of gives you a good way of getting, further expiration and still getting some premium. Always try to get a positive cash on the roll, try to get some credit into your account, but it's not always possible. So sometimes, especially if the stock moves very fast in a short amount of time, you may actually need to put some cash into the trade. And so the next thing, don't go too far out. If possible, again, choose near expiration dates when possible, right? Uh, for the rolls, it's usually okay to wait till expiration day. For the dividends, however, don't. you have you have to roll one day before the ex-dividend day. So occasionally, so I'm saying usually it's okay to wait till expiration date, but occasionally you may need to roll earlier. And that's usually when your option is deeply in the money, then it has a very small time value left, and that means that you have to roll the option even before the expiration date. So what are the risks from managing the calls this way? So the only risk really compared to holding the stock or ETF without covered calls is the possibility for an assignment, right? If you just hold the stock and the stock goes down, you are at a risk. If you hold the stock and you have covered call on it, it's the same risk, really. Actually, it's slightly better because you already got a little bit of the premium from the covered call. So the biggest danger for me as an investor is I hold a stock, I sell a covered call on it, and the stock starts going up really fast and really strongly, right? So then there is a danger of the calls being assigned to me and the shares being called away. If you don't want the shares to be called away, you have to watch for the time value of the option. So if the time value is small, you have to roll right away. Here's a little more detail on the dividends, right? So if the time value of the option is the same or almost the same as the dividend that is about to be paid, you must roll right away. The market makers are essentially waiting for this to happen, and they will try to uh, exercise the option, you know, assign the call to you and call your shares away before the dividend gets paid. And then you don't have the shares, you don't have the dividend, and it's not good, right? So, example here, assume that the XYZ stock has an ex-dividend date on the 4th of May, right? And the dividend is 50 cents. So, the Wednesday, the day before, assume that the XYZ stock is trading at 52 and my short covered call with a strike price of 50 is trading at $2.40. So you would look at it and say, hey, intrinsic value is $2. The difference between the strike price and the price of where the stock is trading, right? So the intrinsic value is $2. So the time value is 40 cents. It looks pretty good until you realize that a dividend of 50 cents is about to be paid, and the time value is actually less than the dividend. So all the time value is really the dividend, and in fact, it's smaller than the dividend. So in this case, if you don't roll, the market makers will exercise the option and your shares will be called away from you. So you have to watch for these events. And so on Wednesday, on the 3rd, the one day before the ex-dividend day, you have to roll the option. So what are the rewards? Well, I look at the covered calls as free money, right? You have to be careful. You have to write them far away from the current stock price. But if you do it carefully, in many cases, it's really free money. And so instead of just holding the stock, you get some additional immediate income into your account, which is always good. And you can use it to buy more shares of the same stock, or you can use it, to pay yourself some money, things like that. So, of course, the risk is that the shares will get called away from you, but the risk can be significantly reduced by managing the calls correctly. So let me give you a few more examples here. So there is another Microsoft trade here, right? Here, this is the old trade I just finished here. And the new trade after Microsoft earnings, it went up. I looked at it and thought that Microsoft is overbought, and I was expecting on Friday it would go down. Unfortunately, it did not. It went up again. So my strike price was very close to the current trading price because I wanted to get some decent premium. And unfortunately, Microsoft went up higher. So I was able to I was able to roll the option, get some premium for it, So I rolled it from 305 to 307 and a half. I got some premium on it, and it was only 1 week later, right? So 1 week later, again, it turned out that Microsoft had a strong Friday. Actually, the whole market was strong on that day. And so I had to roll the option again. So I rolled it. This was the time when I rolled it. It wasn't very good time, so I didn't get as much money on the roll, but I still was able to get some positive income or positive credit to my account, right? And I rolled it from 307.5 to 310 to another expiration. So 1 week later, slightly higher strike price, and then finally here, uh, Microsoft closed below the strike price, so I got to keep all the premium and I got to keep all the shares. Another example, AMD. So again, I started the trade, thinking I think this was just 2 weeks to expiration, uh, and I was thinking AMD was trading around 81, and my option strike price was at 88. Right? That's like 9% higher. So I was thinking there's no way AMD can go that far in 2 weeks. Well, it did. So, and it quite a bit actually. So in 2 weeks, it raised, AMD went up over 18%. That's a very quick move, right? So that Friday, I actually wasn't able to do much. I could go only from the strike price of 88 to strike price of 90 and extended extended the trade by just a week. And so from March 17th to March 24th. And I had to pay actually a little bit. So you can see here, I got credit of under $400 and I had to pay a little over 400 just to extend the trade by a week. And the next time, so AMD continued going up. So the next roll I did from 90 to 93. So again, I was not able to roll it much, but I extended the trade again from 24th of March to 21st. So I extended it by 4 weeks, right? Which is quite a long time. And I was thinking, well, either it works or not, right? Either in 4 weeks, AMD will be below this strike price, or if it continues higher and higher, I may have to get my shares called away. Thankfully, AMD kind of reached the top here and started going down. And towards the expiration, it was actually trading below my strike price. And I was afraid it might start going up again. So, because the Fridays lately have been very strong, stocks were moving up on Fridays. So, I decided to buy back the shares on Thursday. I paid 10 cents per share, so very little. But overall, if you have 5 contracts, that's 500 shares. So, still, I had to pay $50 to buy the shares back. But overall, I made tiny profit, right? But I got to keep AMD shares. That, as an investor, that's my primary goal. Keep the shares and don't lose any money. Okay. Another tough call, NVIDIA, right? You can see, NVIDIA is the favor of, investors right now, but it was not in February. So in February, I looked at the stock. It was trading at 233, and I was thinking, if I sell the call, expiring less than 3 weeks later. So actually, I think it's just 2 weeks and 1 day. So if I sell the call, 250 call, that's enough from the current trading price, and NVIDIA should not reach that value. Unfortunately, it did, right? It broke through so NVIDIA broke through the strike price and traded around the 258, 260, right? So I extended the trade by a week, and NVIDIA again traded above. I extended another week, Nvidia traded above. Then I extended it, I think, by 1, 2, 3 weeks. And I think at this point, Nvidia was trading very close to the strike price, but still above the strike price. Or even if it's at the money, I don't really want to wait till the very last minute. It's too risky. So I decided to roll it one more time, and still Nvidia was, higher above my strike price. So I did another week, and this time Nvidia closed that Friday below my strike price. So you can see quite a few trades here, but I was able to get positive credit from each roll. Not much, but I was getting some money, right? So altogether, I got like $1,678 from, in 3 months. It's not actually 2.5 months. It's not that much, but it's still income into my account. I can use it to buy other shares, and I got to keep the shares. That's the most important thing. Okay, so let me give you another example, this time with a little more details. Right, so on the 16th of May, I sold to open, Google call, and Google was trading at 120, almost 120, and I actually chose the strike price also of 120, and it was just the expiration was in a few days, and I thought that again Google is overbought, and I fully expected to come down. It did not. So on the 19th of May, Google was about 2.5% in the money, and I needed to roll. I needed to roll the option. So I had a few choices, right? So this May 19th strike price 120, that's the call that I have currently. And it was trading around 250, between 250 to 55. So if I want to roll it and get some credit for the roll, I could either roll, this is 1 week later, I could roll to the strike price of 121. So that's less than 1% away from my original strike price, but also more importantly, Google right now is trading at 122, right? 122.50. So I want to get the strike price that is at least close to 122, preferably above, but it's not always possible. So in this case, so 122 is pretty close. And so if I roll, 2 weeks later, uh, if I extend the trade by 2 weeks, I can get some credit, from rolling the option. So that's what I did. So I extended it by 2 weeks, extended the strike price by 2 points, and got a credit of about $100. And here is the entire trade, right? So this is my first call. You can see the price when I entered the trade and the strike price are very close to each other. Unfortunately, Google kept going up and closed above my strike price, right? So at this point, I extended the trade by 2 weeks, and I raised the strike price by 2 points, right? And 2 weeks later, again, Google traded above my strike price. So this time I extended the trade again, uh, raised the strike price by 3 points, right? I went from 122 to 125, and extended the trade again by 2 weeks. And this time I had to pay a little bit to get it happen, right? So because I wanted to roll further, I wanted to make the call, the strike price even higher. So if I went to say 124, then I could get positive credit. But because I wanted to go to 125, I had to pay a little bit, right? So after 2 weeks, Google actually closed way below my strike price of 125. So, the series, of course, expired worthless. I got to keep the shares, and I made some profit along the way. And you can see during this time, so I started the trade on 16th of May, and 1 month later, on the 16th of June, uh, Google went up by 3%. which is not actually, 3% in 1 month is not that unexpected. What was tougher was here, right? After less than less than a week, Google was up 2%, and after less than 3 weeks, Google was up by 4%. This was the difficult time. This is why I got only little credit, or I even had to pay some money to roll to later expiration. So, what are the words of wisdom? So, can you get extra income without losing your shares? Yes, definitely yes. But does it work 100% of the time? Unfortunately, not. There will be cases when even this strategy, even though it's pretty good, but it does not work all the time. In general, 2023 has not been a good year for writing covered calls because the market actually, especially in the last month or so, uh, it's moving up very strongly. And especially the stocks that I like Nvidia, AMD, Google, they are moving up very strongly. They have strong moves. And for those stocks, it's difficult to write covered calls. But you can see, even with the fact that the covered calls are difficult, I can still make profit and manage the calls and keep the shares, which is the most important thing for me. So far in this year, I have started 18 covered calls, or 18 covered call campaigns, I should say. Many of them with multiple trades, as you saw from the examples. So I have one ISRG trade, and that was assigned to me, but that was assigned to me because I actually wanted to sell the shares, and I was just, waiting for the shares to reach certain price. I have two calls right now open. One is Apple, that looks pretty good, and the other is AVGO, and I have a special presentation on AVGO because that's a very tough call. AVGO has been on a tear. It went up like 20% in 1 month, so it's very strong move. But I'm still rolling, the options and hoping that I get to keep the shares. So out of the 18 covered calls, the covered call campaigns, I should say, 15 expired worthless, right? So I got to keep shares from the 15 campaigns, and of course the profit from the covered call. So overall, these are pretty good results. And as I said, Apple looks good, and the AVGO call, uh, depending what AVGO does in the next few months, I will either get the shares be called away from me, or I'll get to keep them. I'm still hoping that I get to keep them, but it's a very tough battle. Okay, so remember, as always, avoid earnings announcement for your calls. If you want to keep your shares, avoid earnings announcements. Avoid major policy events like interest rate decisions, things like that. But that's not always possible. So just be careful. Know that these events are kind of happening and adjust your trading accordingly. And as I said before, watch out for the days before the ex-dividend days. I got bitten by this several times, actually, very recently. so and that was when I was trading SPY ETF, right? So there's another presentation of that coming up. And I'm convinced that with solid management strategies, you can be profitable over long term and keep your shares. So that's all for today. If you like the presentation, please click the like button below. Subscribe to my channel. There is many presentations like these coming up. And until next time, happy trading.